It was 9:30 a.m. on Wall Street when the market opened, and within seconds, something strange began to happen. Stocks didn't just move, they lurched. Prices spiked, collapsed, recovered, and collapsed again, faster than any human could click, blink, or even think. Billions of dollars vanished and reappeared like ghosts in a machine. And somewhere, buried inside that chaos, there was no panic, no shouting traders, no ringing phones. Just code, silent, invisible, deciding the fate of markets in milliseconds. For over a century, Wall Street belonged to people in suits, analysts, brokers, fund managers shouting across trading floors. But today, something very different sits at the center of global finance. Not a person, not even a company in the traditional sense, but intelligence, artificial intelligence. And it is quietly rewriting the rules of the stock market forever. To understand how deep this change goes, you have to go back to a time when speed meant something very different. Not too long ago, making money in the stock market was about reading balance sheets, following news, and trusting human instinct. If a company announced strong earnings, investors had hours or even days to react. The game was slow enough for thought. Then came machines that didn't think slowly. They didn't think at all. They calculated. The first wave was high-frequency trading, programs designed to execute thousands of trades in the time it takes a human to blink. Firms discovered something unsettling. If you are faster than everyone else, you don't just participate in the market, you extract from it a fraction of a cent per trade. That sounds meaningless until it is repeated millions of times a day. Entire fortunes were built on microscopic delays between exchanges in New York and Chicago. Fiber optic cables were laid not for communication, but for speed supremacy. But even that was just the beginning, because speed alone doesn't explain what came next. In 2010, the world caught a terrifying glimpse of what happens when machines lose their balance. The market plunged nearly 1,000 points in minutes in what became known as the flash crash. Blue-chip stocks briefly traded at absurd prices, some for a penny, others for $100,000. Then, just as quickly, everything snapped back. Humans watched in confusion. Machines just kept reacting to each other. No single trader caused it. No single company intended it. It was feedback loops. Algorithms feeding on algorithms, reacting faster than any human oversight could interrupt. It was the first public warning. The market was no longer fully human. But while regulators scrambled to understand speed-based trading, a quieter revolution was already forming in the background. This one wasn't just about speed, it was about learning. Artificial intelligence began entering finance not as a replacement for traders, but as an assistant. At first, it was simple. Scanning news headlines, detecting sentiment, flagging unusual activity. If a CEO sounded confident in an earnings call, AI would mark it as bullish. If uncertainty crept into language, it flagged risk. Then it evolved. Machine learning models began studying decades of market data, price movements, volume shifts, macroeconomic indicators, even weather patterns and satellite imagery. Suddenly, AI wasn't just reacting to the market, it was trying to predict it. One hedge fund, Renaissance Technologies, became legendary for this approach. Its secret wasn't human genius in the traditional sense. It was mathematical pattern recognition at a scale no human mind could comprehend. Hidden relationships between variables that looked random to analysts were feeding machines that never slept. And the results were staggering. While traditional investors debated and second-guessed, AI-driven funds executed thousands of micro-decisions per second, constantly adjusting exposure, risk, and timing. But the real turning point came when AI stopped being just a tool and started becoming a decision-maker. Modern hedge funds now use systems that don't just analyze data, they generate strategies. Reinforcement learning models simulate millions of possible futures, testing what-if scenarios in virtual markets before placing a single real trade. It's like running evolution thousands of times per second, selecting only the most profitable behaviors and discarding the rest. And here's where it gets unsettling. No human can fully explain why some of these systems make the choices they do. Even the engineers who build them sometimes look at a trade and can only say, the model decided it was optimal. Not because it understood the company, not because it read the news, but because in its mathematical world, patterns aligned in a way that predicted profit. The stock market, once a place of stories, of companies building products, of CEOs making speeches, of investors reading between the lines, has increasingly become something else, a prediction engine. And in that engine, humans are no longer the fastest thinkers, or even the primary thinkers. But the impact isn't limited to hedge funds and Wall Street giants. Retail investors have entered the battlefield too, armed with tools that didn't exist a decade ago. AI-powered trading apps now scan markets in real time, suggest portfolios, and even automate trades based on risk tolerance and behavior patterns. A teenager with a smartphone can now access intelligence that once required billion-dollar infrastructure. But that accessibility comes with a strange illusion, the feeling of control. Because while individuals think they are making decisions, they are often following recommendations shaped by the same types of models used on Wall Street, just simplified, packaged, and optimized for engagement. Meanwhile, behind the scenes, markets are becoming more interconnected and more sensitive than ever. A single AI-driven decision can ripple across ETFs, derivatives, currencies, and commodities in seconds. What used to take days of human reaction now happens before a news headline even finishes loading. There is even a growing concern that AI systems are beginning to learn from each other. If one model detects a pattern and acts on it, other models may detect that action and respond in turn. This creates a strange ecosystem, less like a marketplace and more like a living network of competing intelligences. Sometimes they cooperate unintentionally, sometimes they collide, and sometimes they amplify volatility in ways no one predicted. But perhaps the most dramatic shift is not in how AI trades, but in what it values. Human investors often care about narratives, innovation, leadership, long-term vision. AI doesn't care about stories. It cares about probability distributions, risk curves, statistical edges. It doesn't ask, is this company changing the world? It asks, what is the expected return, adjusted for volatility, over the next 12 milliseconds? That difference may sound technical, but it changes everything. Because when enough capital is controlled by systems that think this way, the market itself begins to reflect it. Prices move not just based on human belief, but on machine perception of human behavior. And that creates a strange feedback loop. AI predicts humans. Humans react to AI. AI learns from humans reacting to AI. A cycle with no clear center, no single mind in control. Of course, regulators are trying to catch up. Circuit breakers, audit requirements, transparency rules, each designed to slow down or explain what these systems are doing. But regulation moves at human speed, and AI moves at machine speed. That gap is where the future is being shaped. Still, not everything is dystopian. AI has also made markets more efficient in many ways. Fraud detection is faster. Risk modeling is more precise. Liquidity is deeper. Information spreads instantly across the globe, reducing some forms of manipulation that once thrived in darkness. But efficiency has a cost, unpredictability in new forms. Because when everything reacts instantly to everything else, stability becomes fragile. Like a tightly tuned instrument, capable of perfect harmony but also sudden resonance collapse. So where does this lead? Some experts believe we are heading toward fully autonomous financial ecosystems, where AI funds trade with other AI funds, continuously optimizing capital allocation with minimal human input. Others believe humans will remain essential, but more as supervisors than decision makers, stepping in only during rare moments of crisis. And a few worry about something even deeper, that markets could eventually evolve into systems so complex that understanding them becomes impossible even for their creators. A black box economy. A world where trillions of dollars move every day based on logic no one fully comprehends. Yet for all the uncertainty, one thing is already clear. The stock market is no longer just a reflection of human behavior. It is becoming a reflection of machine intelligence interpreting human behavior. And that shift is not coming in the future. It is already here. Every trade executed in milliseconds, every algorithm adjusting risk, every AI scanning global news feeds at a speed no human can match. It is all part of a transformation that is still unfolding, quietly, relentlessly, and permanently changing what it means to invest, to speculate, and to understand value itself. Because somewhere between human intuition and machine prediction, the stock market stopped being just a marketplace and started becoming something else entirely, a thinking system. Thanks for watching. I hope you enjoyed the video. If you want more content like this, make sure to like, share, and subscribe to our channel. See you in the next one.